Okay, so I want to briefly illustrate this idea of the merit order curve and balancing supply and demand and how that impacts the price. So we're talking here about the wholesale price. We're talking about balancing supply from power stations, from generating sources, with wholesale levels of demand. And in particular, we're talking about doing that on some kind of market exchange system where people are bidding in prices and bidding in how much electricity they want, and hence coming to a price balance. So let's consider a hypothetical market where we've got these kind of demand curves on the left. So we've got a similar pattern in summer and winter. It's just that summer is higher than winter in general in terms of demand at any point in time. And so we can see that the demand varies from a low point of 20 in the middle of the night in the winter, and it goes up to a maximum of 50 in the middle of the summer during, in this case, kind of late afternoon. And it can vary anywhere in between, and we'll see as I vary that demand at the top, you'll see the red bar on the chart on the right is going to move about. Don't worry for the moment about the other lines, we'll explain those in a moment. So on the chart on the right, we're looking in gigawatts, and we're looking at the level of demand and how that's changing over time. And we're going to be matching that with obviously a changing level of supply. Okay, so let's get this one out of the way. Now in practice a demand curve wouldn't be a dead straight line. You wouldn't have the same level of demand at every price from 0, in this case up to 200. It would look more like that. There would be a slope on it. And in keeping with your basic economic theory, at higher prices, the level of demand would be slightly lower than at lower prices. In other words, if the price of electricity is very high, there will be some users who will reduce their demand. If electricity is very cheap, there'll be some users who will increase their demand. In practice, for electricity, the demand curve will be fairly steep, which means that even for quite big variations in price, the variation in demand is not necessarily so large. It's what we call price inelastic. There's relatively little sensitivity of electricity demand to price. But just to keep the illustration simpler, I'm going to remove that slope and just vary demand up and down as if it is a straight line. So on this chart we've got here, we're plotting amount, gigawatts along the bottom, against price up the left-hand chart. Now one point to make is that when you see merit order curves, the x-axis tends to be in units of gigawatts, whereas you'll notice the price at the side is in cost per units of energy. And because that's what, on a market, that's what people are buying and selling. They're trading energy generally. So you could argue that's slightly odd. Why aren't we plotting energy along the bottom and the price of energy at the side? And I guess the best way to explain that is that, as we saw from our demand curves, the level of demand is going to change on a continuous basis throughout the day. And at any point in time, we measure demand in terms of power, in terms of the rate at which we want to deliver energy. When we're trading, our market will tend to have trading periods, maybe an hour, maybe half an hour. So the best way to think about this is that our demand in gigawatts is our average power demand in one of those trading periods. Obviously the amount of energy supplied will be the actual amount supplied during any period multiplied by the amount of time that level of demand was supplied for. And in practice, of course, within those periods, because you'll have continuously varying levels of demand, there are going to be some other financial mechanisms whereby at any instantaneous point in time, we're still going to have to be able to tell suppliers to turn up and down their supply, or alternatively consumers to turn up and down their demand to balance on a very fine scale. And there'll be other market mechanisms in place to do that, and there'll be costs involved in doing that, particularly if you're having to change the amount of supply by large amounts in short timescales. It could be a very expensive thing to do. But in this case, if you imagine this merit order curve as looking at a day-ahead market, so we think that in a particular period of time during the following day, we're going to have a certain average level of demand, which this red line is capturing. And then obviously what we want to do is we want to match that with the relevant amount of supply. And this is where we get into the idea of a merit order. And so our supply curve on this chart is shown by this blue stepped line. And the supply curve is made up of a bunch of different sources of power energy supply. And they've been stacked up in order of the amount they're prepared to supply for, so their bid price. So that's controlling how much each step goes up on the y-axis, and what's controlling the width of each step on the x-axis is how much they're prepared to bid, how much of that demand they're prepared to meet for the price that they're bidding. So for example, that first step is made up of what I've just called a base load 1. You can imagine maybe that's nuclear, able to provide 12 gigawatts at this point in time. And to provide that, it'll want a price of $10 per megawatt hour. And then the following step, which again I've just generically called baseload 2, maybe this is coal, maybe it's hydro, who knows? It depends very much on the market you're in. But again, the width of that step is 10, so it's another source of supply saying it will deliver 10 gigawatts at the moment in time we're talking about. And to provide that, it'll want to have a price of $20 per megawatt hour, and so on and so on. We basically stack up these different sources of supply. And in practice, our curve would be much more of a curve, because those steps wouldn't be a whole 12 gigawatts of nuclear. You might have individual bids from all the different nuclear power stations, and they might have similar prices, but they might be subtly different. One might bid 10, one might bid 11, one might bid 12, and so on. And so on as you get further down there. And then obviously off to the right of our supply curve in blue, the bottom of our table on the left, that curve is going up quite steeply. And that's getting into what I've just generically again called peaking generators, which aren't promising to provide huge chunks of the overall demand, but when they do provide, they're wanting to sell for a very, very high price. So that's our supply curve, merit order curve. And the bid price, to a large extent, is going to be determined by fuel costs. In kind of economic theory, that bid price should be what we call the marginal cost. In other words, it's the cost for any producer to produce another unit, another megawatt hour of electricity. If they can't sell it for more than it costs them to produce, then it's not worth producing any more, and so that will limit the amount they're prepared to put into the system. If they can sell it for more than it costs them to produce, then obviously it's worth doing. And if we think for the moment about conventional supplies, so fueled power stations, the cost to produce is largely going to be made up of the cost of burning fuel, because you've bought in the fuel, you burn it to produce electricity which you sell. So selling the electricity has got to cover the cost of buying the fuel. There may be some other costs in there. There may be costs to run the generator, but largely the marginal cost is going to be driven by the cost of fuel. And so what you tend to see in a supply curve is that as you go down that table, as you go off to the right on our blue line, those last steps are going to be the more and more expensive fuels. So it'll be things like diesel generators. It will be things like open cycle gas rather than combined cycle gas, because they're less efficient, so they need to burn more fuel costs to produce the same amount of electricity. In practice, what we'll really be talking about is something called long-term marginal costs, which might not be quite as simple as the fuel cost at a particular point in time. But whatever the details, you've basically got suppliers that are happy to supply at a lower price on the left, moving up to suppliers that need to supply at a much higher price on the right. And so our economic theory is saying that where our demand is met by supply, that will produce the market price. And so on this chart, our demand is currently 40 gigawatts. When we stack up our different sources of supply, it's crossing, the red line is crossing the blue line at this point, and that corresponds to a market price of $70 per megawatt hour, which is shown by the dotted black line. Every supplier to the left of that point will be able to sell our electricity for that market price. It means that the last one in that supply curve is actually bid $70 per megawatt hour. If that is truly reflecting their cost to produce, then they're not really making much profit. Obviously, down at the bottom, our first baseload units that were bidding down at $10 per megawatt hour are making a nice profit of 60 on every unit of electricity they sell. And it means that at the far end, we don't need our peaking generators. There's simply not enough demand for them to be required. And so, obvious point from that analysis is that as we move our demand curve, then the point at which that crosses the supply curve is going to change. So if we move it upwards, if we go to higher demand, so now we're going into our summer afternoon, for example, we've got the same sources of supply, but much higher demand. Now our peaking generators come into play. And so this time our market price, where our demand curve is crossing our supply curve, is way up there at $170 per megawatt hour. And remember, everyone gets that. So now our peaking generators are presumably making enough to stay in business. That's why they bid. And everyone else below, if they can also supply at those peak times, is making a fortune. So they're all delighted by it. And if we just briefly nip back to our daily demand curves, you can see that we're up here. It's not happening for very long, so those kind of prices in this hypothetical market will be for maybe just a few hours over an entire year. The absolute peak of demand in the summer, hot sunny day, air conditioners blazing. Most of the time we're going to be way below that, and so the price will be below that. Equally, if you go to the other extreme, if we go to our middle of the night in winter when demand is very, very low, so move the demand right down to 20, you can see that now our demand curve is crossing our supply curve much lower down. The market price is down at $20 per megawatt hour. The only providers we need at that point are what we've called our baseload 1 and 2. So at the moment we've been changing our demand curve, so let's put that back up to somewhere in the middle. What could change that? Say it's the same time of day, same season that we're talking about, so I'm not going to vary our demand now. But one thing that could cause market prices to go up, for example, is if we suddenly lose a bunch of our supply. So what if we have breakdowns? What if a couple of our nuclear power plants go offline and now we've only got 8 gigawatts of baseload? Maybe some of this second step of baseload goes offline as well. Maybe there's some real breakdowns and we've only got 4 of those. So what you'll notice here is that in effect, because we've got much less supply at low cost, the demand curve hasn't moved, that's stayed the same, but the supply curve has all shifted off to the left. And so now the point at which we're crossing over is much higher up. So one reason you can get spikes in demand in some markets is because you have some of your cheaper generating sources taken offline, normally for unexpected reasons, unexpected breakdowns, etc. And again, that can be an issue if you've got old fleet. Obviously, if you get those breakdowns happening at times when you've also got very, very high levels of demand, if I move this back over to the right, then as I've drawn it at the moment, I've actually not got enough supply. If I've not got enough supply to meet demand, then that's a blackout. In practice, of course, you may need to switch on more of your peaking supply. You may need to increase these quite dramatically, but to increase that supply, they may want a much bigger price. So let's increase that to 8, but say they want 140. Let's increase that to 10, but say they want 230. Again, we can meet our demand with sufficient supply, but we're going to have to pay for it. So again, that's a combination of very high demand levels, breakdowns, lack of supply at the cheaper end of our supply curve, bringing in the need for much more expensive options at the top end of our supply curve, and so that where our supply matches demand ends up at being a very high price. To bring on that extra capacity at such high prices is often a case of it being very short notice. Again, for those real peak demands, we're probably talking about a relatively few hours in the year when we reach them. Okay, so let's try and remember where we had these to begin with. I think that was down at 12. That was at 10. This was more like 4 and 3 or something. Again, prices were a bit lower. Doesn't really matter. Okay, so far we've just talked about merit order curve in terms of conventional supplies. So the supply curve, that stepped curve, largely reflecting cost of fuel, marginal cost to generate another unit of electricity, and then how changing demand, which will depend on time of day, time of year, where that crosses is then producing a different market price. And beyond demand, the other things that can influence that market price are changes in supply. In particular, if we find ourselves with a lack of the cheaper generating resource at the left-hand side of that merit order, we have to start tapping into much more expensive sources over on the right. And if we have a lack of supply at the very peak times of demand, we could either get blackouts or we have to bring in potentially very expensive extra peaking capacity to keep the lights on, and that's going to cost us money. Now, what about renewables? You'll notice on the chart I've got this thing called RE price, renewable energy price, which suggests immediately that I'm treating it rather differently from the conventional sources. And you'll notice on our table of supply, I've got renewable energy here. And at the moment, I'm saying 0, so I'm assuming no renewable energy in the system, and we'll come back to the bid price in a moment. So let's put our demand back into central location. What if I add renewable energy into this market? And in particular, what if I add something like wind or solar, geothermal, a source that has no fuel cost? If I'm running a solar PV farm or I'm running a wind farm, it doesn't cost me any extra to produce a unit of electricity because I'm not paying for the sun or the wind and then using it to produce electricity. That's arriving for free. With wind, you can argue that turning the turbine blades might over the very long term produce a bit more wear and tear, but it's going to be minuscule really. With a solar PV farm, there's literally no extra cost to producing that extra unit of electricity. If the sun's out, falling on the panels, producing electrons, you may as well sell them. So your marginal cost is 0. And so in this system, what that means is that your bid price is going to be 0. So let's start adding some renewables into the system where the marginal cost is 0. Okay, I've added 3 gigawatts of renewable energy, renewable power generation into our supply, into our merit order curve. And what you'll see is that that's producing another step, but because the bid price is 0, marginal cost is 0, it's basically pushing the rest of the supply curve off to the right. Now at 3 gigawatts, that's not really changed anything. The market price is still, in this case, $50 per megawatt hour. But clearly if I keep pushing that supply curve off to the right by adding more 0 marginal cost renewables into the system, all bidding in at 0, then ultimately that red line is going to cross my blue line at the next step down. So if I do that, add another couple of gigawatts, now suddenly my market price has dropped from 50 down to 30. By adding that renewable source, or likely a mix of renewable sources, into my market, I've actually reduced the wholesale price of electricity. And the reason for that is I've shifted my supply curve off to the right by pushing in lots of 0 marginal cost electricity on the left, which means that my demand curve, which hasn't moved, I'm talking about the same time of day, same time of year, same level of demand, I'm able to meet that demand using fewer of my more expensively fueled supplies off to the right. And that's an impact that you see in real life. In Germany, for example, where you've got huge amounts of solar energy in the system, when the sun's shining and all those solar farms are producing electricity, they can fulfill a huge amount of the required demand, which really leaves very little space in the market for other generators. And so only the cheapest ones that can provide will provide. And so the wholesale price will plummet. And you see that in real markets in Germany. And it also has big implications for obviously all those suppliers on the right which have now disappeared out of the graph, because where in the past they were able to produce, they had a market opportunity to generate electricity, some of that market opportunity has gone. It also means that, even if I take a slightly less extreme version and move up a notch, remember that everyone gets the market price. But because this market price is lower, if I'm on base load 1 step, in this case the first step above 0, at this level of demand, I'm now getting a market price of $20 per megawatt hour when I've got a marginal cost of 10, whereas in the absence of renewable energy in the past, I was getting a market price of $50 per megawatt hour, same cost, same marginal cost. So my profits, even if I'm still able to enter the market, my profits have reduced dramatically. And the other point to make in that, of course, is that if we think about it from the point of view of the renewable providers themselves, if I push renewables back into the system, then there'll be a couple of other things that's worth mentioning. So let's put in 5 gigawatts into our system. And at this level of demand, I've lowered the market price to $30 per megawatt hour. So everyone else is making a bit less money. Now, if I was the renewable power generator and I was getting that market price, again, I'd still get 30. And bear in mind that my bid price is 0, my marginal cost is 0. So again, it's just making the point that separating this idea of a 0 bid price from the actual price that you get. Now, of course, one problem would be that if renewable energy became a very popular thing and more of it was pushed into the system, then eventually, as a renewable generator, I'm going to see my margins decrease as well, my profits, decrease as well. Because now, with 25 gigawatts in this particular system at that level of demand, I'm only getting $10 per megawatt hour for my electricity. Simply because I've now got other renewable competitors, if you like, who are pushing the price down. In the past, when there was only me and a few others, I was getting $30. I was getting 3 times as much revenue for generating. Now, one issue, of course, in real markets is that that doesn't happen because renewable generators tend to have fixed prices, either government-regulated feed-in tariff prices or power purchase agreement fixed prices with their buyers. And so, for example, that might be what's shown by the green line. I could be in a market where, as a renewable source of generation, I'm pushing the supply curve for everyone else off to the right, and so I'm reducing the price at which that meets the demand curve. So I'm reducing the price of electricity for everyone else, but I might have this fixed green line price. So as more and more renewables are built, more and more go into the system, the market price is dropping, and everyone else's profits are dropping. But as a renewable provider, I've got my renewable energy price. That's a fixed price, and so my profits are exactly the same. And so again, that's been quite a contentious issue in markets with high penetrations of renewables, where you have seen this merit order effect. You have seen on sunny days there's lots of PV. You've seen the wholesale price of electricity drop quite substantially, which hits the profits of everyone else. But you've protected the renewable electricity generators by giving them fixed feed-in tariffs.